Hello everyone, a very good morning, good afternoon, and good evening to all. Myself Vaibhav. Today is the first session involving a new series. Starting today, we will be using multiple indicators on the Visual JForex platform. Earlier, we used to use only single indicator. Now that is going to change. We will use. Thank you, Janice. Now, starting today, we will use multiple indicators to consider formations which are likely to be profitable, and these formations will be simple, but just the case will be that we will rely on multiple indicator formations. So there is the Visual JForex board which has been developed by the Dukascopy Bank SA. In today's session, we will use one of the Bill Williams indicator, acceleration deceleration oscillator, and along with this, we will also consider a volume indicator, the volume. So here it is. We will not go into the functional aspects of these indicators. We will more concerned with uses. We will see how we can take a formation and design and develop an algorithm on this platform to automate our trading formation. So these are the two indicator blocks which we have to customize as per our requirement. We have to define these parameters depending on which we will be getting this output value. Here we have to define these 5 input parameters, and then we get these 2 output values, the positive and the negative. And in the case of volume, we get the output, single output, depending on these 3 input parameters. I will give you a brief idea of what the logic is going to be on the JForex platform. I have already plotted the indicators, both the indicators AC2 and the volume. This is the hourly formation of the Euro USD. The logic is quite simple. We want to trade with the trend, and for that, we are relying on the combination of the two to make sure that we don't really get involved in situations where the underlying instrument may not move anywhere, and many false trade signals get generated. To avoid that, we are getting confirmations from two separate indicators, and if the combination is telling us that this is the moment to go for a new trade, then we are likely to have a higher probability of ending that trade in a profitable note. So that's the reason why we are going to rely on two indicators instead of one. And logic is kind of simple. We want to trade with the trend. For that, we are relying on the positive output of the acceleration and deceleration indicator. Only if the output value for this indicator is in the positive territory, we will look for the buy trade. And with that, we will also consider the volume formation. The volume should be on the rise, and that will mean more and more market participants are willing to participate in the newfound bullish momentum, which is being identified by the acceleration deceleration indicator. But if the volume data is not conducive, if the volume is not showing the rise which we want, then that means the market participants aren't really enthusiastic about these new turn in the acceleration and deceleration. So if we get the simultaneous go ahead from both these indicators, only in that scenario we will go ahead for the trade. And to make sure that we don't really get involved in any and every signal, we will set the condition in such a way that we will have a higher chance of the momentum being sustained. So for that, not only we need the acceleration deceleration output value to be in the positive territory and on the rise, but along with that we need good enough momentum. So we will consider, after the turn happens, after the momentum shifts gear from bearish to bullish, we will need the pickup there. So for that, we will consider the last hour's acceleration deceleration output value to be at least twice of the prior hour's acceleration deceleration output. And only if that is the case, we will go ahead for the trade, and then we will consider the output values of the volume data. And here also the volume should also be on the rise, so the volume output should also double, and only if that is the case, we will go ahead for the trade. And in this instance, we don't really see that happening here. As you can see, the AC2 output value has gone from 0.00013 to 0.00054, so that has more than doubled, but there is not corresponding rise in the volume data, so we will avoid here. So we have to look for other instance where the formation might have been good enough for the trade. And if we go back to 7th June 15 GMT, there also the formation is not happening simultaneously on both the indicators, so that will also be skipped. So we have to actually look for the instance where the volume is also doubling along with the AC2 output. So in this case, 5 GMT on the 6th June, that is also, I think it is the volume which is doubling, but at the same time, yes, we are getting both the green signals on both the indicators. The AC2 data is also doubling and the volume output is also doubling. So this kind of instance, we can go for the buy trade. So if we had gone in for a buy trade somewhere here, the underlying instrument did went on to rise and we saw the gains of around 30 pips happening for the Euro USD. So these are the kind of instances which will be picked up by our algorithm. And for sell trade to happen, we just have to invert these formation. Instead of rise, we will look for the decline in the AC2 output. But even if we are looking for the decline in the AC2 output, the volume needs to be on the rise only. It's not the case that volume needs to drop, volume needs to double, because the volume is an indicator which gives us the participants interest in the underlying instrument, and it should be rising. If the decline is happening and more participants, market participants, are getting involved, that is a clear cut signal for us to jump in. So that's why we are using the rise in the volume data along with the AC2 output. So here the AC2 output needs to be below zero, and at the same time it should be doubling compared to the prior hour's output, and at the same time the volume data need need to be doubling as well. And if we consider this instance, it is not really happening, so no new trade will happen there. And let's consider what happens here. 1 GMT of 8 June, no, so no trade will happen. All right, so let us look for an instance where this is the 14 GMT of 1st June, and here also the volume is quite high, but it is not exactly doubling, so no new trade will be taken up by our algorithm. Let me figure out at least a single case where our algorithm might have picked up a trade. Not here. I think here it might have happened. This is 23rd GMT of 23rd May. No, the volume is not showing corresponding rise. So I hope even if we are not really able to figure out or find an instance here, but I hope you got the idea of what the requirements are. Let me check for this. Yes, the AC2 output has more than doubled in negative territory, and at the same time, we are seeing significant rise in the volume data. So the underlying instrument is showing the increased selling pressure here, and our algorithm would have gone for a short sell trade on these prices. And from there on, as we can see, the Euro USD went on to decline by at least 40 to 50 pips from this point to its lowest point. So we do have a formation which is likely to provide more positive trades compared to the negative trades. By positive, I mean the trades which are likely to end in a profitable manner. So we now go back to the Visual JForex board and we have to customize these two indicator blocks and also add a couple of info blocks to get the price volatility data. And prior to that, we have to get the instrument subscription done. For that, we are going to need a couple of logical blocks. So I am going to take logical blocks here. These are the if-else statement blocks. And if you have been a regular viewer of the series involving the Visual JForex board, you might be quite aware what we do. You just have to join it to the start point, which can be any of the three: on candle, on tick, or trade event. This time around, we are working with the on tick as our start point. Default instrument comes here, on tick instrument. So we match both these input parameters. First input should equal second input. Then the tick instrument should equal the instrument of choice. So I have to search for Euro USD, as we are working with the Euro USD as the instrument of choice. Let me find it. Okay, here it is. Afterwards, the position amount needs to be equal to 0 to make sure there is no existing pending or open position on the account. And guys, at any point, if you feel like you need further clarity on anything I'm explaining, you can just write it in the feedback and I would be answering any queries raised. All right. Candle period will be changed to hourly as we are dealing with the hourly time frame formation. The lookback period will be 1 for the first acceleration deceleration indicator. These two parameters will be left with the default formation. I won't be tinkering with the fast period and the slow period. And we are going to need one more of the acceleration deceleration indicator block as we are going to use comparison over last 2 hours. So for that, I have to take multiple blocks of these indicators with the lookback period of 1 and 2 respectively. This will be changed to hourly with the lookback period of 2. Now coming to defining of the input parameters for the volume indicator, the default instrument remains as it is. Candle period I will change to hourly. And the shift will be 1. And then we need one more of the volume indicator block. So I am going to add one more. The candle period here also needs to change to hourly. The only difference is going to be this look back period, which will be 2. All right. And afterwards, to look at the price volatility, we are also going to rely on the price formation. For that, we need info blocks, the get historical candle. So I am going to add 2 more of this with the hourly candle period and look back period of 1 and 2 respectively. And to pinpoint the exact entry point, we also need the 10-second data. So for that, I'm going to add 2 more with the candle period of 10 seconds. Coming to defining of the input parameters for these info blocks, this will be changed to hourly. This one will also be changed to hourly. And here the look back period needs to change to 1 and 2. And also the look back period will be 1 and 2 respectively. Candle period of 10 seconds. All right, so these are the indicator blocks which we will use as per our requirement according to the formation which we are going to build using the logic which I had explained to you in the start. So far, so good. And as I see, there is no query so far. So I hope you are understanding the formation I have explained. And we can also do one thing. We can add certain requirement involving the difference between the opening and the closing value. So that will set the condition that there should be at least minimum opening and closing difference between the last hour's opening and closing price minimum difference, and that will be helpful in instances during the off market hours. By off means the primary market is not open for the underlying instrument, and in this case new entries will be avoided. So I will take one mathematical block here, and this will be a bare minimum condition, nothing special. 10 pips for Euro USD should be good enough. On an average, the hourly volatility, hourly price move in the Euro USD tends to be above 15 pips. And in past couple of months, starting from Russian invasion and even prior to that, if we go back in time for last 1 or 2 years, since the COVID started, the market volatility has been on the higher side. Prior to that, the Euro USD's hourly price volatility used to be around 10 to 12 pips. These days, it is higher. So if you go by a difference of 10 pips, that should serve your purpose. And if you want to keep it higher, you can do that. If you want to keep it lower, you can do that as well. So we have to take a default instrument pip size and multiply it with a variable which we have to define. So for representative purpose, I am taking a start value of 10. You can change it. You can take a different value if you feel like. There is nothing sacrosanct about this particular value. All right. And this will be A1 into A2, and we will name this newly created hourly variable as hourly price difference, HPD. Okay. So these are the blocks using which we can set the conditions for the execution of the buy as well as the sale trade. So this is the bare bones structure, or you can say this is the skeleton on which we will have to put some clause in the coming session to define the conditions for execution of the trade. So for the day, we stop here. I hope you have been able to understand the logical formation, logical requirements, and then the execution part of it. So thank you all for joining in. For further coverage of the market developments, do check out the Dukascopy Analytics page. We are also available on the Facebook page. You can leave your feedback there. You can also join in for the in-depth discussions. For carrying out the testing and also for trading purposes, you will need the assistance of the JForex platform. All these useful links have been provided in the bio. Thank you all for joining in. See you next time around. Till then, goodbye.